If you just knew what the stock market was going to do next year, you could get rich. Stay tuned, because on this episode of Friends Talk Financial Planning, we'll tell you how to think about the stock market for 2021. Hi, I'm John Scherer, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Mermel, and I have a fee-only financial planning practice in Chicago, Illinois. John, we get inquiries about what's going to happen in 2021. And so I'm wondering what you tell people.
You know, it's interesting, Bridget. I used to talk about, and what I think the truth is that, listen, nobody knows what's going to happen in the stock market going forward. And if they did, they wouldn't tell us about it, right? I wouldn't tell you about it, right? But there's a different way, and I've come to realize that really what's going to happen, and here's what I think is going to happen this year, is that there's a 75% chance that the market's going to be up this year. Right. So there's a chance it doesn't, but really high odds that the market's going to be up. And at some point during the year, I don't know, it might be mid-year, maybe depending what happens with the vaccine early in the year, but I expect the market to go down 10 to 15% at some point during the year. But then on the full year, it's going to be up about 75%.
Wow.
So that gives a little bit more, gives you some confidence, right? Like, some interesting data. Yeah.
So you think that there's a 75% chance that the stock market will be up for the year? It's not going to be up by 75% this year.
No, thanks for that. No, it's not going to be up 75%. That would be right. That'd be front page news.
That'd be great.
No, 75% chance we see positive returns in the stock market. And then again, at some point during the year, expect it to go down 10 or 15%. Here's why I say that, Bridget. Let me share this with you, is that I get this data from the Guide to the Markets from JP Morgan. So we got data as of December 31st. Let me skip forward to this page over here that gives us these bar charts, right? And so this is factual data going back to 1980. And the gray bars on this chart are the S&P 500 returns on the year. And you can see, 0 is the baseline here. So 75%, 31 of the last 41 years has been positive returns. And then these red dots down here, those are the intra-year declines. So between January and December, how much the market has gone down in that decline, or inside the year. And of course, last year is a great one to look at, right? Last March or February, we had 33% downturn, but we ended the year positive. The year before that, we had a 7%. It went down during the year. We ended the year positive. 2018, we had 20% down. It was late in the year. The year was negative. Right. So every year, one of the interesting things about this chart is that every year there's a downturn. And it says here the average of those is about 15%, 14%. Right.
Wow.
And so when we take a look at this, it's really interesting that, boy, that sure sounds a lot sexier. We got a 75% chance the market's up. And it's not because of what I think about the economy or what I think about unemployment or the new tax laws. All those things is because this is what happens over really long periods of time, right? And then the idea of, hey, the market's going to go down something like 10 or 15%. It's not because, again, of the new president or taxes or the vaccine. It's because this is what happens in the markets. And if you can think about that, when the market does go down 10 or 15% at some point this year, what's going to be the headlines? What are you going to see on your news feeds and that? It's vaccine is not as effective as we thought it was, or unemployment skyrockets, or fill in whatever I call it, the apocalypse du jour, right? There's always something, and it always feels different, right? I mean, it always is. And then you go like, oh yeah, wait a minute. No, when the market's down 8 or 10 or 15%, that's kind of what we expect to happen over time, right? You go, oh yeah, it's sort of like big yawn. And so, the reality is that nobody knows what's going to happen in the market this year, and I don't know what's going to happen in it, but odds are that we're going to have a positive year, because that's what happens over time. And this data goes back many decades before this. This is a handy way to look at it. And again, if you're interested, you can go Google JP Morgan's Guide to the Markets. There's a lot of good information on here, but I think this is really useful one to look at as we think about what's going to happen in the market. Is, golly, we don't know. And then, chances are that it's going to go down at some point. Look at those red dots. I mean, it goes down almost every year at some point, but most of the time we end up positive. And so that's just an interesting sort of a pithy way to look at those things. But that's the truth of things. And we could talk for hours on why this isn't that important anyway. That's not the important driver in success, right? I mean, that's not what you
Well,
talk
it
about with your
engages
clients.
people's emotions. And so that the people make a lot of money decisions based on their emotions. Now, here's another question I have for you, because this is another inquiry I get, or sometimes people think this is, geez, the market, I hate watching my 401k go up and down. I might as well just take my money and go to Vegas. Because it's Vegas is actually quietly, it's probably more fun, than watching my 401k go up and down, and I want to just go to Vegas. What are your thoughts there?
Well, at least you get the bells and whistles, and you might get a free meal in Vegas, right? I mean, there's something like
Right.
that. There are shows that go on, and those sort of things.
Right.
And I'll tell you, it's interesting that I talk about gambling and how that relates with investing all the time. And one of the things, so there's that slide that we were just talking about, that right, there's a 75% chance historically that the markets are up. Well, out in Las Vegas, if you pay attention to how they make their money out there, the advantage, everybody knows that you lose money in Vegas, right? Over time, Vegas, the house always wins, but their advantage is very small relatively, something like
Right.
average 5%. It's in the single digits, right? If you're a
So
blackjack
that
player,
means that they win 55%. The house wins 55% of the time, and the gambler wins 45% of the time.
that's right. That's right. It's really close to a 50-50, tilted in the favor of the house, right, of the casino, but it's a pretty thin margin because people have to win or else they'd never go back. The
Right.
nice thing in the stock market, if the stock market loses, nobody cares. Everybody keeps on investing in the stock market, right? And so when you think about those two things, hey, it's common sense. Everybody knows that, Vegas, the house wins over time. That's a losing proposition long term. And yet the advantage, that difference is really small, and yet we're afraid of the stock. We can be afraid of the stock market in various fashions, and yet the advantage of investing in the stock market is really big compared to the downside. So it's an
Right.
interesting dichotomy where and you said it just a minute ago, it's emotions that we accept that idea in Las Vegas. We see all the big buildings and casinos that they make and all the money that goes to the house. You go, oh yeah, that's having a
Right.
45% chance of or 55% chance of the house, that's a huge house advantage. And then we think about when we invest in stocks, we've got a huge house advantage, like over time, 75%, but it doesn't feel that way. It's that emotional thing. And then part of it is the news cycle, right? Because it is unemployment, and it is, a trade war, and it is the price of oil, or fill in the blank, right? And we read that and we see that every day. And yet if you're able to step back and take that macro view, it's common sense, hopefully prevails, but that's not easy to do. That's the thing that makes investing such a difficult task. So um, what do
It's
you tell
hard to it
clients
can be
about that?
hard to tune it out. Yeah, I
That's
try
right. Yeah.
to I try to explain to people that there's an ongoing storyline with the stock market that the press picks up, and whatever some people say is the stock market up and down is, first of all, that's a record of the day traders. So whenever there's this explanation of the stock market's up or down because of unemployment, because everybody's on Zoom now, and so productivity is going to be higher, or there's a stimulus packages out, or all the other explanations for why the stock market is up right now. That's just an explanation for the tip of the stock market that's up, and that's up, and it doesn't reflect the general tide. So it's not the big tide. It just reflects the top part of the market for people that are doing activities that I don't recommend doing. So that's what I try to get people to tune out to, that storyline, and tune into, like, looking at their whole net worth, not what's going on in any one little part. So having a bigger view and looking at what's happened long term. Okay, where are you at 10 years ago versus today versus now? And look at that, not where were you last week versus today. So those are the
Abs-
things that I try to get people to focus on,
so
rather than focusing on what are my predictions.
let me you said a couple really awesome things in there, and one of the things, and I think it sort of encompasses, and maybe that's a good way to wrap things up and look at the takeaways, is that it's a component. Investment returns important, but it's a component of your plan, and having a plan in place And then this is one of the cogs in the wheel, but it's all, but
Right.
it, you've got investing, you've got how much you pay, or savings, how much you save, how much you pay in taxes, how much you spend, all these other factors that are so important. And
Right.
investment return is just one of them, right?
Right.
And
Absolutely.
the other thing that you said is talking about, hey, this is just the tip of the iceberg, right? I always wonder about when they say investors, sold to the market. I'm like, who are these investors? Nobody I know is out selling things, right?
Today,
But that idea,
because of
so
that, no, they sold money because they needed some money.
right, right.
That's,
I,
but the
I,
people that I know, that's why they're selling. Is I needed
I,
some money today, so I sold,
right.
or I've got some money, so that's why I bought. Not
Or I see the market go, I see the
so I can
market
run
going up or
employment.
going down, and that makes me react, not the underlying cause, right?
Right.
It's so I'm a scuba diver, and so it's interesting that for people that have done any kind of scuba, when you're below the water, right, it's just kind of calm. We do a lot of diving in Cozumel, and there's a current, and you kind of drift along, and it's just serene. And there are times you come up, and you can see the boat up above you, and it's just rocking on these, waves, and it's raining out there, and you've got no idea because we're under the water how smooth things can be relative to that top surface. And so that's a really interesting way I'd never thought about explaining, that concept is that, man, you get down 20 or 30 feet, the ocean's not roiling down there. It's that top 5 feet where it is, right? And
Right.
that really does apply to investing. And how to think about this news cycle and what goes on in the markets and things. So I think the number one takeaway that I'd have for people here is, number one, have a plan and understand that investment return is just a cog in the wheel of that overall planning. That overall net worth is what you're trying to accomplish. And then the other thing is just that, you can make it sound really appealing.
Right.
75% chance the
Right.
market's up and
Yeah.
this thing down. And you go, golly, we got to listen to this guy. He's got it together. And the answer is that nobody knows this stuff, and it's not that important, right? Nobody knows what's going to happen. And if your plan is set up right, it doesn't matter what happens in the next year. That's my real
Right.
takeaways. I don't know if you had anything else to add to that side of it.
No, I just really appreciate your take on this. I think a lot of people will relate to it. Both the 75% chance of the stock market going up with 15% going down at some point during the year. I mean, that really helps. Like, this is what you can expect.
Yeah, don't be surprised when the
That's what
market
you
goes
can
down.
expect.
Right.
And but the thing is that it's not every year. Some years it's not like that. Some years it goes down, but 75% of 25% of the
Yeah,
time it'll go down. And that's okay. That's just what this game is.
yeah,
And the point is to look deeper and not let your emotional brain get carried away. Uh, Try to rely more on your wisdom brain or your long-term thinking and not your
that's right.
short-term thinking. So,
So if great, I'll let you take it away, Bridget.
okay, great. I just wanted to wrap it up saying, first, subscribe. That
That's
helps us
right.
with the algorithm. So go down and subscribe. The second is we're both involved. The reason we know each other is we're both involved in an organization called ACP, or the Alliance of Comprehensive Planners. There's planners all over the country that think about things the way we do. And you can check out acplanners.org for more information.
Great. Thanks,
And with
Bridget.
that, John, I'm going to wrap it up. Thanks.
All right. Till next time.